Saturday morning to you, and welcome to On the Mark. Along with Mark Papa, I'm Gary Byron. Mark is the owner of Financial Resources Group. Financial Resources Group. They're out of Glastonbury, Connecticut. You can find them online, by the way, at www.frplan.com. frplan.com. More importantly, you can call them. You can schedule a consultation with them very easily. Just write this number down. You can call right now, but he's busy. We got to do a show. But I want you to call. So if you call right now, you'll just get his voicemail. If you can wait till the end of the show or sometime later today or throughout the weekend or maybe in the early part of the week, that would be great because I don't want you to miss anything here. It's all valuable information. That phone number, write it down, 860-657-8380. One more time for you, 860-657-8380. If you missed any of those points of contact, no worries, because I will repeat it at least a couple of more times before the show is over. Mark, great to see you there, buddy.
Happy New Year, Gary. How are you?
I am not doing too bad. You know how it is. This time of year, it's dark early, it's cold, there's snow. It's just a lot of people spend, you know what it is? They spend time indoors, and in other words, they're not out that much, and they're planning their year. And I would imagine that in financial planning, it's a great time to kind of regroup and start the slate anew, right?
I would say great time to renew and good time to break old habits as well. We have clients calling in. They want their RMD already for the beginning of the year.
Sure.
And if you haven't seen, the markets are actually reacting very positively to some of the news that, we're looking at potential rate cuts. We're going to talk about all those forecasts today, which I don't rely on forecasts, but you have to know what might happen, both the pros and cons. But, yeah, there's people who, want to take a big chunk of money out earlier in the year, and we're like, well, you have a great market here, and we're working with folks to plan so they never have to take an RMD with the Roth Blueprint, which I'll be doing on the 20th of January, 6 p.m. at Ruth Chris Steakhouse. So I'll say that again, the Roth Blueprint, 6 p.m. at Ruth Chris Steakhouse. And what we do
on the Berlin Turnpike in Newington at what time?
6 p.m.
Is this complimentary? Do people need to sign up? How do they get a ticket to this?
Well, they can call into the office. I have a bunch of mailers going out, so they can respond to the mailer. If not, 860-657-8380.
Same phone number.
Give us a call, and we can enter you into the system manually. Bring a friend, bring family. But the Roth Blueprint is going to show people a way to actually convert their IRA to a Roth IRA without depleting their balance. In certain cases, we have ways of showing them how to pay the taxes, within the IRA. Actually, someone will actually help them pay the taxes. So we have a lot of different ways to do it. But, at the end of the day, the main claim of the Roth Blueprint software, it's to show people up to a 97% increase in wealth over their lifetime. And it's amazing. It's very powerful. And Gary, we're doing big cases. My guys who invented this software, they're doing large conversions. People with like $4 or $5 million
really
in their Roths, in their IRA, and we're converting them to Roths over, let's say, 3 to 5 year period. And we're able to do that in a way to keep people in the same tax bracket as well. So we have so many different ways to do it. But people, if you're a fan of this radio station, you shouldn't be paying RMDs. You should be sitting down with somebody like me to figure out how to get out from under those taxable IRAs. Because in that presentation, Gary, I talk about the 6 chain reactions of RMDs. And all it does is raise your taxes throughout, potentially raise your taxes, but significantly for most people throughout their retirement, it increases their tax bill. And we'd have a very, very short window with the OBBB, permanent quote-unquote tax cuts that just passed. Very short window to do these conversions because I think in 6 to 8 years, taxes are going to have to go up when we have $40 trillion in debt. So.
Is this a complimentary thing? Do they have to buy a ticket?
No, it's complimentary. It's complimentary, but there is a tremendous amount of value. Yeah. And we use an example of a couple with $1 million in $1 million retirement, and then by the time they're done converting, and not only money that they'll have tax free, but then the legacy they leave to the next generation. It is a significant increase in wealth versus just spending down those IRAs. So.
Okay. I want to talk to you a little bit this morning about let's compare the comparison of 2026 and 2025 economic as well as market forecasts. Let's kind of maybe break this down a little bit for us.
Well, let's do it. I would say that most of these forecasts, one, we don't like to rely on forecasts or future things, and nor is the past any indicator of what the future is going to bring, right? So we don't like to do that. What we like to do, and we'll be talking about this in the next episode, is making a diversified portfolio. So no matter what the economy does, oil does this, interest rates does that, sell off here or there, you're able to stay the course. Which is how we run our firm. But I would say 2026 estimates, I would say that the forecast for what the market's going to return, I think, are rather low. I would say I'm very bullish this year. And everyone wants to proceed with caution. We don't know if the Supreme Court is going to strike down Trump's tariffs. We don't know if interest rate policy, which I think we're going to see at least 3 cuts in 2026. I think we're going to see at least 2 right away. And there's 2 reasons for that. One, we have sort of a soft labor market, and we're working with some data that isn't all that clear because of the government shutdown. I also think that we have a midterm election that we want to get this economy stimulated sooner than later. But if you look at both fiscal stimulus, and the fiscal stimulus essentially isn't government spending, it's tax cuts coupled with rate reductions in the Federal Reserve rate cuts. Those are both extremely bullish signs for the U.S. economy. And you saw, the last GDP print of 4.3% was a huge surprise above what the forecasters were saying. So I think we're up for a pretty good year. Now, the other negative, aside from the tariffs potentially getting struck down, is will this amount of stimulus cause inflation? And will inflation come back? Will inflation come back to the point where rates actually go back up, the natural rate, natural interest rates go up because we're seeing inflationary stimulus.
So the Fed policy has a lot to do with interest rate outlook.
It's humongous. And, every time the Fed's cut rates, over periods of time, a lot of times they cut rates in a recession, or pre-recession. But I think you're going to see 2 pretty preemptive cuts. And then the third is that whoever Trump picks as Fed chair, there's another risk that the Fed loses its autonomy and the political side of things the Fed becomes more political than it does analytical, and they're designed to should be a separate entity. So I 100% support the Fed being independent of the federal government, of the president, because I think what happens is if you can get fiscal and monetary policy to align correctly, meaning you can get Congress not to spend too much, right, and you can get these guys not to cut too much, and they can control inflation. Their big problem is you can't get Congress not to spend too much.
You know why I'm laughing, right? Yeah, you just said it. Yeah, you can't get Congress.
Would that be my utopian scenario? Wouldn't be my utopian scenario would be, as a free market guy, would be to have an absolute, very tight, excellent, well-run federal government, right, absent of all the fraud and what's going on in Minnesota. And, let's face it, there's tons of fraud in the government, tons. Clean up the government, have a nice balance sheet. That would be my dream scenario, but we're a long way away from that. But anyway, so
all right. How about the S&P 500 earnings estimates?
Well, I think you're going to see a pretty sizable jump year over year in the S&P 500 earnings estimates as well.
Well, it grew, didn't it?
Yeah, it's between 10 to 15% is the projected increase in earnings. A good chunk of 2025. About 2% of our gross domestic product was coming from this artificial intelligence data center boom spend. The amount of money being spent on AI is ginormous, and it's going to continue. So that's a long-term trend, Gary. That's not something that we should be trading. But at the same time, you don't want to be in a short-term trade on those individual companies. They're long-term. You have to look at the long-term capital expenditures and what they're doing and why they're doing it. And they know something we don't. And the bottom line is I think that's a long-term trend that you need to be long on, but you shouldn't have 100% of your portfolio in just the Magnificent Seven, which I've been harping for a long time. And in the next episode, I'm going to talk about why I think a more balanced approach is going to be better for 2026. But yeah,
so
I think you're going to see some of those rate cuts, and I think they're already kind of baked into the market. We're off to a good start already.
When you look at economic growth forecasts, though, the U.S. GDP growth in 2025, what did you say? It averaged around 2 to maybe 2.5, slowing from 2024's 2.8 due to higher rates early in the year and trade frictions, but supported by consumer spending. Global growth was approximately 3%. Let's look at some of that. Let's start with the Federal Reserve via professional forecasters, and let's work our way into some of these growth forecasts, starting with the Federal Reserve.
Yeah, well, I would say a lot of the forecasting, a lot of the information that's being used by all these government agencies, whether it's the Labor Department, Department of Labor, whether it's the Fed, whether it's the IMF, the World Bank, OECD, which is the Organization for Economic Cooperation and Development. They all have their economists, but they use their econometric estimates. And I think a lot of that, I unfortunately believe it's outdated. I don't think it factors in the service sector. I don't think it factors in productivity. I think it's outdated. I think that the numbers that they're projecting for the global economy are somewhat accurate. You have the EU, who they are starting to reduce interest rates there. Japan's raising interest rates at the same time, which is kind of crazy, but they're doing that to in a way to kind of, they have all those retirees. They have people who are they've been at a zero interest rate policy forever, so they're realigning their government their interest rates to maybe pay savers and reward savers. So they have a totally different regime. And I haven't done a ton of research on Japan, but the Japanese stock market has been for many years undervalued. And I won't get into it. I can do a whole episode on Japan, which maybe one day I will.
Should.
But, the EU, on the other hand, I mean, I was just reading an article it was the agricultural, I can't remember the exact article, but they've been negotiating the same policy, Gary, for 25 years, and they still haven't come to a resolution. 25 years. So it goes to show you how bureaucratic the EU is under the regime. In Brussels. So, it's almost like very, very hard for the EU to align all the countries to fall into those restrictions. So countries don't really have the autonomy, but if you have rate cuts happening in the EU, and they're all trying to monetize their debt, every single country, United States, Japan, the EU bloc, are all monetizing their debt right now. They're all trying to devalue their currencies a little bit so that they can help pay the interest on this massive debt that they took out during COVID. But that is stimulative. So if you look at last year, you had a very big move in the MSCI index, which is the benchmark for the European, or not the European, the global markets, the MSCI. And then you have another thing called MSCI-AQUI. But yeah, the MSCI was probably the best performing broad index. It was the best performing.
How does the World Bank factor into this?
I mean, the World Bank is they're a large. I really don't know much about the world. I mean, they're an important institution. The IMF is an important institution. What they're forecasting, I think the number 2% growth for the United States, or the and 1.8 I think a lot of that is political. And I think a lot of it is dramatically underestimated what the true value of the U.S. economy is. I think we're the leader in AI. We're going to be the leaders in productivity. We're eventually going to have, I don't know if you saw 60 Minutes, these humanoid robots.
I did.
We're a leader there, and the Chinese are not far behind. They might be a little bit ahead of us. But you're going to see, and an interesting thing, Gary, this is kind of not something you're going to see in the headlines, but I was when you talk to older professionals, they talk to us about how, you have where the biggest piece of unemployment is new graduates. They're having a hard time finding work. And there's a gap between their actual skill level and what they're demanding for pay and salary, what they expect. And there's a huge gap. And I think some of those jobs are going to get replaced, but unfortunately those beginning, those, starter job, whatever you call them, starter jobs, entry level, are, and some of those mundane tasks that they used to get. Now, when I was on Wall Street, they'd be sending you out, when you first started, your first 3 weeks, you're just doing coffee runs, for the boss. They wouldn't even let you pick up a telephone. But you're not going to get. It's almost like a hazing period, right? So young people, I think they're going to struggle to find work in this environment right now.
What about Goldman Sachs or Deloitte, or maybe even the S&P? Some of these other institutions. How are they?
Well, I mean, everybody has an economist. Everybody has an opinion. There's people who want to talk about the impact of tariffs. We still haven't seen any meaningful impact on prices through tariffs. Now, you may have seen prices didn't come down as quickly as a result of the tariffs, but they certainly haven't spiked up that much. And then you saw just recently Trump backed off some of the tariffs that he was proposing on, let's say, Italy for imported pasta. That would upset a lot of people. It didn't make me very happy. And you walk into some of the Italian markets and you say, gee, what's going to happen to these poor grocery stores with, stacked full of these Italian, the Giacheccos and the Barillas and all these wonderful pastas that, it's a big, big part of the Italian economy is, so thankfully I'm glad that Trump came to his senses. But, I don't think tariffs are going to be all that big of a deal going forward the economy. And I also think we can reach the 2% inflation target, as we move forward. But I think it's going to be accomplished through efficiency, productivity, and you're not going to see prices drop. This whole affordability thing. Prices spiked under Biden. They overstimulated the economy. There was all that government spending. They did that second round of stimulus that we didn't even need. The economy was doing just fine. They went and spent all that money. They did the green bill and the Inflation Reduction Act and all that money still hasn't even been spent. Okay, so that as well is actually kind of a put option underneath the economy. But if you take a look at the big picture, inflation prices aren't going to go down. What has to happen is they have to stay somewhat stagnant, and wages and productivity have to rise to offset that inflation. And I think right now we're a little bit behind for a big part of the economy. So that's kind of hurting people. Another thing that hurts it is look, let's say, hey, let's give everybody $25 or $20 an hour minimum wage. That makes McDonald's
unaffordable.
That,
yeah. That's why the Big Mac is so much it is.
Yeah, that makes McDonald's unaffordable. That makes your Starbucks unaffordable. So those are things that people are feeling. Unfortunately, I think Starbucks is a luxury, if you want my opinion. If you're not making, real good, you should be drinking. I mean, we serve Maxwell House in our office,
Folks, you are listening to On the Mark, along with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. They are out of Glastonbury. You can find them online at frplan.com and 860-657-8380. I'll repeat, all those points of contact more towards the end of the show. Is there any kind of strength for the consumer here?
Yeah, I think so. Again, I think in 2025, consumers demonstrated a lot of resilience. Again, despite what the headline said. We had wage growth outpaced inflation, as I mentioned earlier, 4.3% versus 2.4%, supporting 70% of our gross domestic product, or 70% of our domestic economy, is despite lower job growth, you still had a steady consumer, a confident consumer. We'll look. I haven't seen much that came out of what the final tally for retail sales are, but it'll be coming out this month. As long as I think we had a fairly strong holiday season. So I think we're going to be okay. And again, I think you're going to see the labor market pick up again. And I think that's why you're going to see further rate cuts.
What about the housing market? That's been controversial for the last.
Solid.
Yeah.
40% of the homes in the United States are paid off. The other 40% have mortgages. I think it's below 4%. And then it's the 20% who are paying, the ones that are who went and bought homes and they're paying rates at the higher rate. Those are the areas that could potentially be troublesome. if, the economy erodes, or those loans were non-conventional loans, or, loans that people put 5% down and then they lose a job, or a spouse loses a job.
Do you see the rates going down in 2026?
Yeah, absolutely. I think we're going to see at least 3 rate cuts.
In May? Like when there's a new Fed chairman?
Yeah, I think you're going to see 2 front-loaded cuts, sooner the better, and then we're going to wait and see on the 3rd. That's what I think is going to happen for sure.
Each a 0.25%?
Yeah, 0.25%. Because, again, you have to let the data come in before you can decide what's really happening. And inflation has not been an issue. It really hasn't. It's an issue in the news. It's an issue in the media. Yes, things are more expensive. But you can't have an economy that grows without inflation. Some inflation is good. You need price growth. You need wage growth. You can't have inflation. Right. So you need.
Here's one for you. Most
people don't understand this stuff.
Right, and that's why we're here. Let's talk about consumer debt levels. It's at an all-time high.
Yeah, that is an issue.
It's in trillions. Oh,
yeah, it is, and consumer debt levels are up there. I think that's always been a concern. But as interest rates come down, I think, when interest rates go up, people tend to pay off their debt sooner because they don't want to pay more.
Right.
And as interest rates go down, that means there's more that people can afford. So hopefully they'll use that as an opportunity to pay down their debt. But then there's a whole segment of the economy that just charges it off and goes bankrupt, which is why we have to pay high rates. So I don't say that. I'd say it's at a high level, it's at a fairly high level, but I don't think it's at a historically high level to where we're going to see it could put us into a recession. It's just not there.
Is there any productivity growth?
Yeah, I think you're going to see productivity growth in 2025. It rose 3.3% in the second quarter. The annual average is about 1.6%. However, I think as artificial intelligence becomes more and more prominent, in business, I think you're going to see a massive, massive leap in productivity, similar to what we saw in the internet, similar to what you saw with the PC, similar to what you saw with the internet. I think this is going to be very, very big. And for 2026, productivity increases are forecasted about 1.5 to 2.5%, and potentially higher due to AI. I don't think we're going to be able to see or even quantify where this productivity increase is coming from. But let's face it, Gary, let's think about this. This is why we're talking about those antiquated economic numbers. They don't even have a good way to calculate productivity. How many times I signed my kid up for baseball on my phone when I was waiting in the grocery line? Could you do that 20 years ago, 10 years ago?
You couldn't even do it 10 years ago.
10 years ago, maybe. But I was able to sign my kid up for Little League.
10 years ago, I had to go in person.
Or I'm returning emails. If you're waiting in line for the grocery, I'm in the middle of an email, and I'm returning that to a client. You know what I'm saying? It's like, what's the big deal? So there's a lot of productivity that does not get factored into the numbers that we're using. And that's just me. I'm 54. I watch my kid pick up a tablet, and he doesn't even bother typing. He just hits the voice button and searches whatever he wants.
I only got about 4 minutes left. Let's talk about a model portfolio here.
All right, so let's use this as a segue into the next model. So I want to talk about model portfolios for a minute. As part of my 21-point checklist, my full checklist review, we review other people's portfolios, and all I'm saying to the audience, there is no better time to review your portfolio, and not just with your advisor, but with a third party like me. I am a portfolio manager. I am in charge of designing the firm's model asset allocation. I am designed to reduce risk. We're looking for the highest possible return for the least amount of risk. But we're also looking for areas that we can benefit from that are undervalued. So we're not just chasing performance. We're looking for areas of pockets of making sure we have enough money in financials, for example, because, if you look at financials, they're historically very cheap right now. Or, making sure you have enough coverage in the energy sector, which is going to benefit from the AI data center build out, as well as the demand for global energy is huge. So you're going to see, but I am offering that $100 gift card again for anybody who's just willing to bring in their statements and sit down with me for a half hour to 45 minutes to talk about our full checklist review and how we do things. So it isn't just about money. It isn't just about, everyone and their mothers owned NVIDIA and Palantir, and some people sold it too soon. Somebody bought it too late, whatever. But, that's not a portfolio. That's not a retirement plan. You have to have your portfolio correct in order to fund your retirement properly. And if you don't have a correct portfolio, you're going to get caught off guard. And I see it all the time where, I'll look at a portfolio, there'll be 10 different funds in there, and they all own the same stocks. Or there'll be 10 different funds in there, and one fund is charging, almost 1%, and then they have the same exact portfolio that's only charging 0.01%. It's like, why don't you just own the 0.01% versus paying 1% for the same thing? So we see, and then we also see the other thing I'm going to be moving into this year. There's a lot of firms that are pushing the custom index so you can get your tax loss. We do a tax managed version, but it's a quantitative version. When I mean quantitative, we use factors. There's like 10 different screens before. I'd say most people use 2 to 3 screens before their stocks can get built. But we're looking to clean up those portfolios for people who have a whole bunch of stocks, taking a whole ton of risk that aren't doing better than the market. And we can help you tax manage those and help you get out of those portfolios at a very low tax cost, if not a zero tax cost. If I'm also going to be jumping into the IRC 351 arena again, where you can move your entire portfolio in as long as you meet certain criteria. We could trade it in the exchange traded fund, and you'll pay no capital gains on that until you sell down the road.
Nice.
And we can make a much better portfolio for you, a much more well-structured portfolio. And most people don't pay attention to this stuff, and they don't know the kind of risk that they're taking. So,
one more thing, and that is you're going to be at Ruth Chris. It's an open invitation, but they do need to sign up.
Yeah, I only have 40 seats.
What the date is? The 20th.
The date's the 20th.
That's Tuesday of January.
My criteria to get in: you have to have at least $1 million of investable. Be retired retiring within the next 3 months.
Folks, if you'd like more information on that event at Ruth Chris Steakhouse, Berlin Turnpike in Newington, it is a free event on Tuesday, the 20th of January, so it's coming up. Or you just want to schedule a consultation with Mark Papa. Very easy to do. His office is in Glastonbury, Financial Resources Group out of Glastonbury. Online at frplan.com. F as in Frank, frplan.com. And 860-657-8380. One more time, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Mark Papa from Financial Resources Group. Until next Saturday morning, have a good one, everybody. So long.